Economics is a science that studies the allocation of rare resources employed to the satisfaction of needs of people living in society. These resources are products, goods and services, and factors of production, labor and capital. The allocation can be performed via different ways: lottery, queuing, auction, reservation, or market. Among others, markets facilitate the allocation of resources. Their purpose is to improve the price discovery process, reduce the cost of transacting, and enhance liquidity. Markets are places where resources are exchanged between buyers and sellers. By extension, markets refer to transactions of these resources. After these few words about economics and markets in general, let us now focus on the financial markets. What is the specific purpose of this kind of markets? Broadly speaking, the purpose of financial markets is all about raising capital and matching those who need capital, the borrowers, with those who have it, lenders. A couple of questions arise: where supply meets demand, and who are the borrowers and lenders? Lenders are mostly individuals or private companies. Borrowers can be individuals, companies, but also governments, municipalities, or public companies. Financial intermediaries such as banks help borrowers to find lenders. Banks take deposit from those who have money to save and bundle the money up so that it can be lent to those who need it to borrow. More complex transactions than a simple bank deposit require markets, in which borrowers can meet lenders and existing commitments to borrow or lend can be resold to other people. Stock exchanges are a good example. Companies raise money by selling shares to investors, and existing shares are freely bought and sold. When the money is lent, it may simply be a deposit with a bank. Most of the time, however, the borrower will issue a receipt for the money, a promise to pay back. These pieces of paper are, in the most general sense, what we call securities. The securities are essentially, all the time, promises to pay back, which show key information: how much is owed, when it be paid, and the rate of interest to reward the lender. A major characteristic of modern financial markets is that the securities are typically freely bought and sold. Let's go with other definitions. First, an asset is any possession that has value in an exchange. Then, a tangible asset is one whose value depends on particular physical properties. In opposition, intangible assets represent legal claims to some future benefit. Thus, financial assets, financial instruments of security, are intangible assets. For financial assets, the typical benefit or value is a claim to future cash. About financial institutions, the entity that has agreed to make future cash payments is called the issuer of the financial asset. The owner of the financial asset is referred to as the investor. Market participants are households, corporate business organizations, or local, state and national governments, or even supranationals. Financial institutions provide services related to one or more of the following: transforming financial assets acquired through the market and constituting them into a different type of asset which become their liability. This is function performed by financial intermediaries like depository institutions, commercial banks, savings and loan institutions, saving banks and credit unions, and non-depository institutions like insurance companies, pension funds, and finance companies. Financial institutions also provide services related to exchanging of financial assets on behalf of customers like brokers and dealers, exchanging of financial assets on their own account, assisting in the creation of financial assets for their customers, and then selling those financial assets to other market participants, providing investment advice to other market participants such as financial advisors, managing the portfolio of other market participants like asset managers. Now let's talk about financial market organization. The first time the money is lent and changes hands, the first time the security is issued, is the primary market. All the buying and selling that takes place thereafter we can call the secondary market. The secondary market is significant as the flexibility it gives makes the primary market work better. Because of the prominent role played by financial markets in economies, governments have long deemed it necessary to regulate certain aspects of the markets. In their regulatory capacities, governments have greatly influenced the development and evolution of financial markets and institutions. It is important to realize that governments, markets, and institutions tend to behave interactively and to affect one another's actions in certain ways. Thus, it is not surprising to find that the market's reaction to regulation often prompts a new response by the government, which can cause the institutions participating in the market to change their behavior further, and so on. Because of differences in culture and history, different countries regulate financial markets and financial institutions in varying ways, emphasizing some forms of regulations more than others. The standard explanation or justification for governmental regulation of a market is that the market, left to itself, will not produce its particular goods or services in an efficient manner and at the lowest possible cost. Of course, efficiency and low-cost production are hallmarks of a perfectly competitive market. Thus, a market unable to produce efficiently must be one that is not competitive at the time and that will not gain their status by itself in the foreseeable future. Of course, it is also possible that governments may regulate markets that are viewed as competitive currently but unable to sustain competition and thus low-cost production over the long run. A version of this justification for regulation is that the government controls a feature of the economy that the market's mechanism of competition and pricing could not manage without help. Now, let's talk about the efficient market hypothesis. A market is operationally efficient if it offers investors reasonably priced services related to buying and selling. A market is price efficient if at all times prices fully reflect all available information that is relevant to the valuation of securities. The existence of financial bubbles is a subject of major interest for financial professionals and a paradox within economic theory. Difficult to identify before the burst, financial bubbles are a fear for financiers and a subject of debate for economists. But first, what is a bubble? A bubble is characterized by a sharp increase in the price of a given asset, unrelated to its underlying value, also called fundamental, followed by a sudden drop in the price of this asset and a return to its fundamental value. A bubble is characterized by a deviation of the price of an asset from its fundamental value, and this concept is in fact directly related to the question of the efficiency of financial markets. In fact, the efficient markets hypothesis developed by pharma in the 70s does not allow bubbles to exist. In an efficient market, the price of assets at time t reflects all the information available at this time t. According to pharma, fluctuations in the price of an asset can be explained by new information leading to new expectations and thus a revision of the interesting value of this asset. The existence of bubbles in the financial markets have thus been an element in the analysis of efficient market hypothesis. On this subject, the work of Scheller in the 80s has been decisive in the academic literature. The author demonstrates that fluctuations in share price are too great to be explained solely by variations, in thus refuting pharma's hypothesis. The existence of financial bubbles thus calls for a fundamental economic problem. How are prices formed? Are the markets efficient? And this debate is still topical. Jane Pharma and Robert Scheller, although they have contrasting points of view on market efficiency, were jointly awarded a few years ago by the Nobel Prize.